About that all day yesterday.
20 seconds or so away from the opening bell. Let's whip through the price action for you. Equity futures negative 0.9% on the S&P. On the Nasdaq, we're down by a little more than 1%. The main event, the last hour or so, it's all about the ADP report coming in much hotter than anticipated, driving equities down and yields much higher. There's the opening bell. Switch on the board and get to the bond market. The bond market looks like this. Treasuries down, yields up and away. Up by 9 basis points on a 10-year through 4%, 4.0271% on a 10-year this morning. Dollar not showing much strength off the back of that move. The euro just south of 109 at 108.85. We're positive on that currency pair by 0.3%. And to round things out in the commodity market, down by 0.4%. No drama there. $71 and about 50 cents. Let's get to one sector to watch at the open. The airlines. JetBlue terminating its joint venture with American following a judge's ruling against the partnership, writing, quote, JetBlue has made the difficult decision not to appeal the court's determination, beginning a wind-down process that will take place over the coming months. The airline now shifting to focus on completing a $3.8 billion acquisition of Spirit Airlines. Kelly Lyons joined us in D.C. for more. Hey, Kelly.
Hey, John, this literally seems to be a matter of picking battles because, as you said, you did have that federal court ruling that its Northeast alliance with American Airlines violated antitrust laws. That was one legal fight they had underway, the other being the challenge to that $3.8 billion merger with Spirit, which JetBlue says it needs in order to scale and compete with the carriers that dominate in the U.S. market. But the U.S. has concerns about market concentration in certain cities that could give that company, a merged company, pricing and competitive advantages. So JetBlue deciding to focus on saving that deal, going to wind down that alliance with American, which is why you are seeing JetBlue and American shares lower in the first few minutes of trading here, each down about 2%, whereas Spirit Airlines, the ticker there, SAVE, on the idea that this may help the odds of that merger actually going through, is up by about 1.6%. I would note that JetBlue CEO Robin Hayes did say in a statement that he's hoping that taking the DOJ's, quote, misplaced concerns about this partnership off the table could help, though, when they go to trial this fall, actually obtain Spirit Airlines. That trial is set to begin on October 16th, John, so we'll all have to eagerly await that result.
Kelly, thanks for that. JetBlue down about 2%, American down by 1.5%, Spirit up by 1.9%. About 2 minutes into the session, we are down by 1% on the Nasdaq. On the S&P, we're down by 0.9%. Much of this off the back of this move in the bond market, off the back of the ADP report about an hour ago. We're going to get some more data in the next 30 minutes. PMI and services, the ISM just around the corner. Job openings as well, so looking forward to all of that. I want to turn to energy. Shares of Exxon under pressure after saying lower nat gas prices and refining margins should reduce its Q2 results by roughly $4 billion. Analysts at RBC Capital weighing in, writing this. The update is likely to be viewed negatively for earnings expectations, and we expect consensus numbers to move lower over the coming days. Abby has more. Hey, Abby.
Hey, John. Yeah, this is not good, and this suggests that the earnings season that we're moving into now could be under some pressure. This is the first big pre-announcement that I'm aware of with this company, basically lowering the guidance below what the street was looking for. They are saying that the lower natural gas prices and the refining margins are going to reduce the second quarter earnings. If you recall, well, actually you were away, you missed this one, but General Mills, their outlook was not great because consumers are finally not willing to pay up for their brand prices. So totally two different sectors, but I think that the big takeaway here from this Exxon this pre-announcement, is the idea, again, that this earnings season that's coming up could be a little bit challenged, and analysts are across the street somewhat neutral here, basically saying that this guidance that they provided was a bearish miss.
Abby, thank you. Stock down 1.5%. Broader equity market near session low, still falling, down about 1% on the S&P 500 right now. Keeping an eye on that. Also keeping an eye on the automakers, Tesla and China's top EV makers signaling a truce to their price war, with top executives pledging to, quote, adhere to industry rules and regulations, regulate marketing activities, maintain fair competition, and not disrupt fair competition with abnormal pricing. David Welsh, the Bloomberg Detroit bureau chief, joins us now for more. David, is that the price war over?
It was already starting to abate even before this. I think maybe they had all pushed each other until they collectively cried uncle. But okay, I think once they go public with this, and they were probably nudged strongly by the government to cut it out, I think probably it is. You may see some adjustments here and there, but yeah, I think they probably will. It's kind of a strangely worded agreement if you look at it. One of the things was promote core socialist values, I think. And they were very careful not to make it sound like price fixing. But I think there is kind of, you know, a collective will to say, all right, let's kind of normalize things if we can. And consumers were very upset about some of these price cuts too, if they had paid more weeks before.
Yeah, you do wonder how much certainty you'd have going out to buy a car and wondering whether in a couple of weeks' time it's going to be much, much cheaper. David, thanks for that. David Welch there of Bloomberg on the latest. Big implications for Tesla, of course, and maybe some good news for Elon Musk. Some not so good news for Elon Musk, with shares of Meta getting a boost at the opening bell. Instagram officially launching its new Threads platform, an app designed as a direct rival to Twitter. The CEO, Mark Zuckerberg, posting his first message on Threads, writing, "I think there should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but it hasn't nailed it." Ed Ludlow joins us now for more again. Ed, question I guess is whether Meta, Instagram, Threads can nail it.
Yeah, there was a lot of enthusiasm at the open. We were up more than 1% on Meta, now down actually flat on the stock, so it was a pretty short-lived higher open. Bernstein has a note out, John, posing this question, whether they could ever achieve critical mass to make it a competitor to Twitter. KeyBank Capital Markets has actually raised its price target to $335 from $280. They see in the near term Threads being an immaterial contributor to Meta's financials, but longer term do pose the question what kind of ad streams it could bring in. You know, that Zuckerberg comment about a platform with 1 billion users and Twitter's failure to achieve that scale, that was kind of the most interesting development to me in the last 24 hours. A fun fact, John, that if you consider all of the user base of Meta's other properties, Facebook, Instagram, and WhatsApp, they would only have to onboard 1 in 10 of each of those users to the Threads platform to eclipse what Twitter was able to do with its registered monthly active user base, 1 in 10, to transfer and outdo what Twitter's done. So I find that to be very interesting. A lot of energy on the platform. I know you've played with it. TK, he followed me in the last hour, a remarkable development, but I think a lot of users do have questions about what this becomes. No ads on the platform currently as an example.
Well, give it time. You'll see plenty of ads, no doubt. Ed, thank you. TK, very distracted by Threads this morning, as you might be able to tell based on the program we delivered a little bit earlier on. Your equity market more broadly is negative by 1% on the S&P 500. I want to stay on big tech just for one further note. Morgan Stanley expected Microsoft to eventually join Apple with a $3 trillion market cap. They wrote this: generative AI looks to significantly expand the scope of business processes able to be automated by software. Microsoft stands best positioned, they think, to monetize that expansion, which, accompanied with a still reasonable valuation, makes Microsoft their top pick in large cap software. Broader market, as I say, is negative this morning. We're down 1%. Yields are a whole lot higher by 9 basis points at the very front end, just shifting away from session highs. Still north of 5% though on 2's, on 10's north of 4% and up 9 basis points today. Amy Wu Silverman of RBC with this to say: post the holiday, we could see volatility perk up again as we head into earnings season. Amy, I'm pleased to say, joins us now. Amy, can we build on that? Why you expect volatility potentially to pick up?
Sure. You know, look, we were obviously last week in the midst of the summer doldrums with the July 4th holiday. But, you know, as we head into earnings season, this historically is a time, in particular in the first 2 weeks, where you see volatility buying. And we really have had volatility just absolutely pummeled, John. You know, data like today perhaps changes it a little, but we've just had really suppressed levels and folks keep selling it even further.
It's amazing to have this backdrop. At the same time, maybe we've had narratives all over the place. We've gone from soft landing, no landing, hard landing, back again. And yet, as you've pointed out, volatility's remained pretty low. And the question I know you're grappling with, and you're hearing this question from clients, is whether we should be selling low volatility. How do you think we should express that? Through single names at the index level? What should we do?
Yeah, it's a really interesting question, and it all comes down to the math, because as we all know, it's been very narrow breadth. Even today, you know, you guys were talking about Threads earlier in Meta. You know, the first thing that comes to my mind as a derivative strategist is, well, where is Meta the biggest, chunkiest weight? It's actually XLC, the communications spider ETF, and so you see that interplay. So is it better to own volatility in Meta, or is it actually better to own volatility in XLC, because one is such a huge proportion of the other? together that you would expect them almost be proxies at this point. And you see that in the market too. So, one thing we've said is if you're looking to hedge, Apple volatility might actually be a good proxy for S&P volatility, given how much of a weight it has become and how low it is in that particular single stock relative to the index level.
Just to recap the price action right now, down 1% across the board. Pretty much on the S&P, we're down 1%. On the Nasdaq, we're down about 1% plus. Similar move on a Russell on the small caps. Amy, I want to pick up on what's been happening with the bond market and what it hasn't done to the equity market so far year to date. If I told you earlier this year where yields would be, where Fed funds would be, where Fed communications would be, I could give you really precise detail on all of that. Would have it helped you make a move in the equity market, put money in the right places, given what's tech's done so far year to date?
It's astonishing. I would have liked to say yes, but I don't know that that's the truth. So, we usually think of the rates market as leading, and, people like to look at rates volatility on a cross-asset basis relative to equity volatility. That ratio just hasn't worked out this year. It's almost been the other way around, and part of it does have to do with that Magnificent Seven really leading the equity market. And this is why, one thing we've been talking about is this could just be a tale of two narratives. I think the market is fixated on the idea of rotation. What if we just get tech continuing a rally because of the AI story, because of stories like Threads? We also get an economic breadth widening at the same time. If that happens, that would tell you that we still lean to be more of a market that's bullish than bearish.
Would that be your base case?
Yeah, look, when I think about that question, I always think about how it's positioned in the market right now for options. And I can tell you there's very little demand for hedging. I can tell you even with volatility at these levels, people are still continuing to sell it. And of course, that can beget something like 2018 where we had a Volmageddon, but can also continue when you look to history. It's not clear that one always leads to a burst of volatility, especially when you have the case of such narrow breadth continuing to drive that positive momentum.
Big moves this morning, that's for sure. Amy, thank you. Amy Silverman there of RBC on the latest moves. As I've said repeatedly, about an hour or so ago, an hour and 10 minutes ago, big economic data print here stateside, an ADP report that many people will tell you they don't care about, and then of course, all of a sudden they care about it. ADP comes in hot. Jobs look very good. Yields start flying. Equities start dropping. We're down 1% on the S&P. On the Nasdaq, we're down by more than that. On a 2-year, back through 5%. On a 10-year, back through 4%. Not translating into dollar strength in a major way. In fact, some dollar weakness against the euro today at 108.81. Some more economic data coming up just ahead of Friday's payrolls report.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense.
The PMI data up next.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. Getting some more data, getting some more information about how the economy is performing, how the past effects of monetary policy are affecting economic activity and inflation, and then basically having a meeting by meeting decision about how to adjust policy.
More economic data just moments ago. Let's get you some of that with Mike McKee. Hey, Mike.
Hey, John. Well, we're getting the S&P version of services PMIs, and they come in stronger than anticipated. 54.4 up from 54.1, and the composite at 53.2 is a little bit higher than the 53 that we saw in the preliminary numbers for June. Now we get the ISM services numbers top of the hour. They're expected to rise a little bit as well. So we'll see if S&P is any kind of precursor to that, but it does suggest there's still some strength on the services side, John.
Mike McKee, it's pretty phenomenal, isn't it? The distinction that you can make between services right now and manufacturing.
Well, Americans spend more money on services, and it's a service economy. So it really matters what's happening there, and the hard part has been deciphering what's happening there because of the jobs picture and the fact that they've had trouble hiring people for many of ththose jobs, at least until we saw ADP today.
Mike, does one necessarily have to converge to the other? Can this persist?
It can persist. As, we don't have a rule on this. We passed goods with services some time ago, and so we'll probably continue to see services be the strength of the economy, although we're spending a lot more money now to try to build up the manufacturing sector in the United States. So we could converge. We could see something like that happen.
Amazing. Mike McKee, thank you. Just another strong data print relative to expectations. We've seen that repeatedly. We've mentioned this repeatedly too, that economic data relative to expectations, that index, the surprise index, the highest since 2021. Strong data early this morning, but I guess good news, bad news. I know you hate that stuff, I do too, but that's the reality in front of us at the moment at least. We're down 1% on the S&P 500. Some data earlier this week. Weak manufacturing in China, we know that story. Weak services data as well, something to keep an eye on. And with regards to China, keep an eye on this as well. Secretary Yellen touching down in Beijing, preparing to meet with Chinese officials for economic talks as trade tensions continue to simmer. Kaylee Lyons back with us with more. Hey, Kaylee.
Hey, John, yes, she's officially there, but her first formal engagement won't be until tomorrow, Friday, where she's set to meet with the premier of China, Li Qiang. She'll be meeting with other senior government officials as well over the course of this visit, which does go through July 9th. But as for what tangible may come out of it, the bar does seem to be set pretty low. The Treasury Secretary, of course, has been expressing her desire to make this trip for months now, but really this is just about opening lines of communication. She is likely to raise issues around trade, around debt relief for distressed countries, issues like climate change as well. But it doesn't seem that we're expecting any major breakthroughs or real deliverables coming out of this meeting. This is really just a victory for the administration in that they are talking. This, of course, follows Secretary of State Antony Blinken, who made his own visit to Beijing last month, and Bloomberg reporting today that after Yellen's visit, climate envoy John Kerry is expected to make his own trip to Beijing to address the climate change issue. But the backdrop here is very, very tough, John. Obviously, there has been a bit of a tit for tat when it comes to the fighting around trade and economically sensitive issues. China, just days before Treasury Secretary Yellen arrived, put export curbs on two very strategically important metals, gallium and germanium, where the U.S. is considering imposing restrictions on China's access to cloud computing. Plus, you have the defense concerns as well. Chinese President Xi Jinping was giving a speech earlier today talking to the military forces around Taiwan, asking them to strengthen drills and boost its capacity to win wars. So geopolitically and economically, a very difficult backdrop for the Treasury Secretary as she starts these conversations.
Kelly, what's your take on this? Does this set the stage for a leader summit later this year? What are you hearing about that?
Well, that's a very difficult question because obviously after Secretary of State Blinken's visit last month, there was optimism that it could set the stage for President Biden to meet with his Chinese counterpart potentially at the summit later this fall. Then just very shortly after, you of course had the dictator comment that President Biden made at a donor event, which China reacted very negatively to. So it's just a question of whether or not the Chinese president may be open to meeting with the president in person, but Biden has continually expressed his hope that a meeting will be taking place in the coming months.
Blinken, now Yellen, as you indicate, Kerry next, and potentially a leaders summit coming up too. Kelly Lyons on the latest there. What to watch over the next couple of days, as we say, as trade tensions simmer, the tit for tat, the back and forth between China and the United States continues. For the broader market, if you are just tuning in, welcome to the program. 20 minutes into the session, equities down by 1% on the S&P. On the Nasdaq, down by a little more than 1%. The data decent, way better than expected on the ADP report. Jobless claims doing okay. In about 10 minutes from now, you'll get a read on ISM services and job openings too. That's really important stuff, particularly with where yields are right now going into it, with a 2-year up by 10 or 11 basis points through 5%, a 10-year through 4%. Let's get you some sector price action. Here's Abby.
Yeah, and that yield story, John, is really affecting, influencing the sector composition. Not surprisingly, with the S&P 500 heading to its worst day since the end of May, we're looking at all 11 sectors lower. Now, super interesting. Real estate is the worst sector, down 1.8%. That, of course, is because as yields go higher, those dividends on the real estate stocks look less attractive. Consumer discretionary down quite a bit, with Tesla being down. Energy, utilities, another dividend-sensitive sector. Tech right in the middle of the pack, down about 0.9%. Consumer staples, which is defense, down the least, down 0.4%. Let's dig in a little bit deeper, though, to tech, because Apple is still below that $3 trillion mark, so tech is down about 0.9%. Apple off of its lows, nonetheless, down for a third day in a row. The stocks over the last 2 days, John, down 3.7%, thereabouts, the worst since the end of April. Qualcomm and Apple suppliers, so this is all very interesting on that hot ADP report ahead of tomorrow's jobs report.
Monster upside surprise there. Abby, thanks for that. Ahead of payrolls tomorrow, 225 is the estimate. You wonder if that starts to bleed a little bit higher as more estimates come into our Bloomberg survey over the next 24 hours or so. The previous number, of course, 339,000 payrolls, 225. That's the median estimate in our survey. 170 is the estimate from Citi. Andrew Hollenhorst caught up with us a little bit earlier on. He's looking for a softer jobs report of 170, but ultimately other data, as we can see this morning, not showing much loosening in the labour market. And Citi's Andrew Hollenhorst looking for another hike in July and another hike in September. And based on the minutes we got yesterday from the Federal Reserve and the communication we've had from Chairman Powell and from the New York Fed President John Williams too, it looks like July, later this month, we're going to get another hike from this Federal Reserve. Coming up next, your trading diary, the runway into the weekend and into payrolls tomorrow morning. 25 minutes into the session, equities down for a second day by 1% on the S&P. On the Nasdaq right now, down by 1.4%. Some real weakness in the equity market off the back of better economic data, sending yields up and stocks down. About 25 minutes into the session, that's the price action. Let's get to the trading diary. Coming up a little bit later, about 5 minutes from now, JOLTS data, job openings in America, and ISM services information as well. Another read on the service sector just around the corner. President Biden delivers remarks on the economy at 1 p.m. Eastern time. Look out for that. We round out the week with the US payrolls report tomorrow morning, and looking ahead to next week, another busy slate of Fed speak and inflation data coming up on Wednesday. We kick off earnings season too. JP Morgan results just around the corner. Tomorrow morning, look out for this full coverage of the jobs report right here on this program with BlackRock's Rick Reeder. Looking forward to catching up with him. Victoria Fernandez across Mark joining us alongside PGIM's Michael Collins, and we'll catch up with the US Secretary of Labor, Judy Su. That conversation just around the corner. From New York City, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, July 6th. Here are the top market stories that we're following for you at this hour. Monster bonds sell-off. You got two-year yields jumping to the highest level in 16 years, throwing fuel on the global bond sell-off after a blowout and some say unbelievable ADP report. And then rates, that's guys saying something about the data. Rate elevator up. You got traders betting on rates above 6.5% in the UK, over 5.5% in the U.S., even before the latest round of eco numbers. And the data deluge, we get JOLTS, ISM services breaking right now. Very excited to see what guys are going to uncover. We get instant analysis from Anthony Nieves, ISM Services PMI Chair from New York. I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. What has made you gasp so?
The ISM number, the JOLTS number is broadly in line, coming through at 9.824 million, down from 10. Oh. That's pretty much in line, but it's the services ISM number. Wow, look at this. This basically completes a picture, I think, which is a very strong data today. ISM services, the headline number comes through in at 53.9, Alex. The last number was 50.3. The survey was 51.2. Prices paid 54.1. Employment comes through at 53.1. That's a pickup from negative last time. New orders comes through at 55. This is very strong data. This is more very strong data.
Yeah, and it looks like as long as the market's taking it, it's going to be good news is actually maybe too good. You're looking at the stocks maintaining their sell-off of over 1%. You got the bond yield still moving higher. Two-year yield is now up by 15 basis points. The three-year up by 16. I mean, when you go to the belly, it gets even worse.
Yep. Yeah, it's interesting. You basically spike back up towards session high on the yields. Let's get some instant analysis on this right now. Anthony Nieves, ISM Services PMI Chair, joining us now for that. Anthony, what is the instant analysis? This looks like strong data.
Very much so. We see an uptick across all the numbers. All the indexes had risen from the past month. We look at the composite and the contributors to that, the four indexes that comprise the composite: employment, new orders, business activity, supplier deliveries, all looking good. We see 15 of the 18 industries have shown a reflected growth month over month.
Wow.
We know that there's some pullback with information technology arena, but overall the numbers look good across the board.
Yeah, and also you have price index dropping to the lowest level since March 2020. So demand holds up and prices move down. That's like good across the board. Can you walk me through the new order numbers? Where are you seeing the most strength?
Well, with the new orders, we're looking at 13 of the industries that have shown increase month over month. One of the bigger contributors to to GDP from this is real estate, rental, and leasing, and that's unchanged month over month. But the two industries that are kind of the anchor that are pulling this back a little bit is mining and agriculture, forestry, fishing, and hunting. But overall, again, 13 of the 18 industries reflected growth in new orders, and 15 for business activity and in the composite index as well.
We've got the labor report coming out tomorrow. We've seen some very strong labor market data today, Anthony. What does your survey tell us about what is happening within the labor market?
Well, we had 9 industries of the 18 reflect growth. One that's pulling back on that is healthcare and social assistance. And that's more attributed to just not being able to find the workers that they need. And we're seeing that as a mixed bag across the different industries, that some are saying that they're just holding back a little bit, being cautious, trying to see what the economic outlook is long term. But overall, the majority are saying they just can't find the suitable, applicable workers for what their needs are at this point in time.
I mean, ADP would seem to reflect something like that, although it was mostly leisure and hospitality, but still. Anthony, how do the industries and survey participants feel about the next 6 months?
They remain positive. They feel the economy is stable, but they're still a bit cautious, especially as it relates to inflation. We know the Fed had indicated that they're looking to, again, do another increase, and that's pulled back on the real estate, rental, and leasing, new construction starts. We're seeing the biggest growth, the largest growth reflected in accommodation and food services, as well as arts, entertainment, and recreation, which indicates our respondents are telling us people are spending money more on experiences versus tangible goods.
Anthony, what impact, if any, are higher rates having on what you're seeing in the data?
Anthony?
I think you may have frozen.
In renovations, commercial side.
Sorry, Anthony, we just had a little glitch on your camera. Carry on.
Okay. Sorry.
Oh, it looks like the glitch is continuing. Okay, we're going to have to leave it there. We'll get Anthony back the next time the ISM services breaks, just to repeat a really strong number. And prices paid falling to the lowest since March 2020. Anthony Davis of the ISM services PMI chair. All right, let's get more on all the data. We also want to unpack the JOLTS number. Bloomberg's Michael McKee has been looking through that. Mike?
Well, Alex, job openings did fall, as Guy pointed out at the top of the show, to 9.8 million, which is down from just over 10 million. And so that, I suppose, is some good news. But there's strength underneath the numbers in the sense that the quits rate, which the Fed watches to see how confident people are in the labor market, goes up to 2.6% from 2.4%. So there's some strength in the underlying numbers. Overall, the number of job openings that dropped the most were in healthcare and social assistance, which Anthony was just saying is the area where people are still trying to find workers. Now, this is May data. It is not June data. It is delayed, so we may have had a change in the way people are looking at things. But the JOLTS data was what the Fed was looking at in terms of tight labor markets. Seems to be loosening up a little bit on the headline area. We'll see if that continues. But the quits rate does suggest that there is some strength in the overall economy. And you put that together with what we got from ADP today and the employment numbers from the ISM Services Index and jobless claims. And you're seeing, I'm looking at the Bloomberg Whisper number, guys, and it's gone from 260 to 269 already. And we'll see about that 225. That's the forecast for tomorrow, whether that goes up as well.
Mike, is Jay Powell having a bad day?
You know, somebody asked me something like that earlier. Jay Powell doesn't want the economy to be bad. He just wants inflation to go down. So, yeah, it's difficult to see inflation going down under these circumstances. I wouldn't say it's a bad day for him, but it just complicates what they're doing. We already had Lori Logan from the Dallas Fed come out and say she was one of the people in the minutes yesterday that had wanted to raise rates in June, and she still thinks we need to raise rates, and maybe more than once. So you're probably going to hear a lot more Fed officials come out leaning that direction. We're probably nailing down a rate increase in July. And then the question becomes, what do they do in September? If we keep getting this kind of strength, then that's going to start getting priced in by the markets.
But Guy, to your point, we talk a lot about the Goldilocks scenario, not too hot, not too cold. This is definitely a too hot thing. It's not too cold. We're nowhere near that.
Yeah, absolutely.
And to your point, like that's why you could look at it as the bad news. The good news is bad news. It's just too good. And do you believe it?
Well, the Fed is...
How many reports have you read about no one believing the ADP?
Yeah, and Mike had a great chart earlier on that basically said that the ADP is coming under the employment report for a really long time. And if you take a look at today's numbers, then that potentially points us in the direction of an epic number tomorrow as well. But everybody's having to incrementally play catch up. We're going to talk about this throughout the show. Are we now in a position where the Fed's go to 6 and the Bank of England's going to 7? We kind of thought we might go to 5 and then we got to 5, and then we thought we might go to 5.5 and we got to 5.5. Are we going to 6 next, Mike?
Well, that's probably what's going to start getting priced into the markets on an month basis, although it'll bounce around a lot because those aren't particularly liquid contracts. But yeah, people are starting to talk about that as a possibility. And remember, there were 3 people who thought on the Fed who in the latest dot plot thought that they would go to 6 or even higher. So it is a realistic possibility. Whether it has to happen or not depends on the other side of this equation, and that's the inflation side. We'll get those numbers next Wednesday for CPI and see if you can have this kind of Goldilocks economy. Hard to know the way things have been going. I tell you, though, if we get a number like ADP and the payrolls number tomorrow, as I told Tom Keene, you'll be doing the show from under the desk because everything will be flying around on Wall Street.
Nice, nice. Well, I have a podium, so it's a little bit different, but fair enough. Point taken. All right, Mike, thanks a lot. Really appreciate it. And I should point out the tech is getting hit hardest, down by about 1.5%. The NASDAQ 100 and yield still pushing their way higher. The belly really taking the brunt here. All right, coming up, we're going to ask that question. Is the Fed going to 6% and the BOE to 7%? That might have seemed crazy like 48 hours ago, but it is not anymore. Catherine Rivera, Chief Market Strategist at StoneX Financial, joins us next. This is Bloomberg.
The Fed is hoping unemployment will rise, but economists think differently.
We might see unemployment drop back from 3.7 to 3.6.
3.5, 3.7, 3.6. It is an extremely low unemployment rate.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Which movable part matters?
We've had so many upside surprises.
We haven't seen the full impact of tighter monetary policy.
The Fed is going to hang tough.
The June Jobs Report, Friday on Bloomberg Television and Radio.
All right, let's bring in our question of the day. Is the Fed going to 6% and is the BOE going to 7%? You are seeing the market move. You got stocks selling off, bonds selling off. The dollar actually hits its highest, the dollar index hit its highest for the session. Joining us now for Insight, Catherine Rivera, Chief Market Strategist at StoneX Financial. Catherine, great to see you. Good to see you in person. What do you think? BOE 7, Fed 6?
There's a chance. Certainly, I think the Fed is going to go to 550 and the BOE 6.5 by March of next year. But given the trajectory of service inflation in both economies, service-based and consumption of service-based, I think there's a very good chance that we could surprise the central banks could surprise the markets, which would be a big downside for equities.
Catherine, what do I want to do in this environment? If that is the case, do I just stick in a money market fund, wait to buy duration, maybe the opportunity hasn't availed itself yet, watch potentially stocks crack under the kind of the heat of these rate hikes? What do you think the market's going to do with all of this?
Well, as our rates team at StoneX says, something has to break. The Fed has to break something to achieve the 2% target. And more likely than not, the Fed has to break the labor market. The labor market remains, we saw that gangbusters report of ADP. We can debate the accuracy of it or not, but the trend is there. And the trend is that we're at full employment with a 6% fiscal deficit. So that in and of itself, that combination is potently inflationary. So something's got to give. And if I'm right, and it's the labor market, and wages have to plummet, and we see some layoffs, we see JOLTS go lower than the 9.8 that was reported today. We see the quit ratio drop because people are less positive that they'll find another job, then I do think you want to rotate out of the discretionary services and tech names that have done so well year to date and move into those sectors that have not, which are the more defensive ones.
But here's what we've been seeing is that you can be absolutely right.
Yeah.
On an economic level and on a market level be absolutely
wrong. Yeah, it's about
it's not even a question, I mean, yes, it's a question of timing, but also the FOMO then winds up sucking you in too. So there is a reasonable alternative to equities. It's the bond market, yet you still see FOMO. Maybe not today, but how do you manage that?
Yeah, Tina's gone because it's the complete opposite, right? You can look outside of equities. You can look at gold and fixed income, even in emerging markets. I mean, you can get long duration, hard currency paper for juicy yields. But I would be careful because I do think that the markets are underestimating the ability and the willingness of the Fed to effectively break something to achieve that inflation fighting credibility that some argue it has really lapsed on.
Do they need to break the financial markets? Do they need to break stocks? At the moment, we've seen a lot of money being put into people's pockets that they're going out and spending. They're spending it, as we've just learned, on services. The economy is chugging along as a result of it. Do they need to break the market as well as the labor market?
Well, consumer confidence, I think, has to come down, unfortunately. That's the main driver of consumption, and consumption is the main driver of the U.S. economy. So if effectively we do need this economic deceleration, then yes, I would say that we need to have a higher unemployment rate. And you can look at the Taylor rule. It depends on your R-star or your NARU input, but the Taylor rule says the Fed should actually be higher than 7%. So that's an input, and I think we do need to see a consumer confidence drop to get service sector inflation kind of decelerate.
I just wonder, Guy, what's going to wind up leading that? I appreciate cracks in the labor market, and I'm going to bring this back to housing, so don't hate me on this one. But if you refi and you have a low rate and you have an extra $800 a month, that $800, say, for example, isn't going to go away. Even if you lose your job or switch jobs or you don't get the raise that you thought, like that's sticky income now.
And the problem that we've got in the UK as well is that you've got a whole bunch of people that don't have mortgages and have cash piles, and those cash piles are becoming more valuable. People are earning decent rates now, and that is putting money in their pockets. And at the moment, you've got a £10 billion gap between the impact of higher rates on mortgages and the money people are earning. Basically, we are 10 billion better off in the UK economy, and that's feeding through into consumption. Catherine, how do we slow down consumption? How hard are we going to have to push?
Well, the Fed has to keep hiking rates, and I think at a minimum they do 50 basis points more to have that impact. Yes, there are long and variable lags, and in the second half of this year we're probably going to see them come to the fore. But certainly we need to see the consumption equation decelerate, and I think that has to do, of course, with a tightening of lending standards, which we are seeing from banks, and a deceleration in labor market activity. And I think on those two fronts, that's where we're going to see consumption drop. We won't have recession, in my view, Guy, until we see the labor market come off. I mean, it's very hard to imagine consumption contracting when people feel good about their jobs, they're earning, they're earning maybe not commensurate with inflation, but they're seeing wage gains, and they feel good about their job prospects. Habits of consumption under that scenario do not change.
Okay, so you mentioned defensive and rotation there. When? And what? I think we have to be kind of counter-cyclical in this aspect, in the sense that while the markets are hot and everyone's looking at tech and chasing the rally, be very careful about chasing the rally. The Wall Street Journal came out with a report, I think this week, talking about retail and older people really chasing the rally and loading up on equities. Caution there. You don't want to be following this trend, especially as we're on the verge of the next phase of the economic cycle. Not in the soft landing or no landing camp. I do think that the next phase from stagflation is going to be recession, not this year, probably in 2024. But prepare now. So get into those sectors that historically outperform in recessionary periods, which are staples and our utilities and our healthcare, for example.
Sounds a lot like Europe. Catherine, is volatility going to pick up? Picked up a little bit today. Are we going to continue to see it picking up? Is the VIX going higher?
If the Fed surprises, I think we could see that, the VIX going higher. If we get a gangbuster non-farm payrolls number tomorrow, which could happen, ADP has been under reporting kind of non-farm payrolls. So I think that could bring some additional volatility as the market reprices the risk of the Fed, perhaps even getting to 6%.
6%, there you go. Fed at 6, Bank of England at 7. Catherine, thank you very much indeed. Great to see you. Catherine Rooney-Vera, Chief Market Strategist at StoneX Financial. Still ahead, 10 million people take to Threads in just 7 hours as Instagram launches its rival to an embattled Twitter. We're going to find out what it's like, who's signing up, what's critical mass look like. That's next. The startup is coming. This is Bloomberg.
It is 22 past 7 on the West Coast. We want to get to the startup. We cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its pretty gloomy, cloudy, foggy morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, it begins with Threads, 10 million users in just a few hours. Talk us through how's it going, what Threads is looking like, and it can actually be a competitor to Twitter.
Yeah, so I was the 132,009th sign up to Threads. So I made it before the first million. Now we're at 10 million. There's so much that's been discussed. The first is the meme that Mark Zuckerberg tweeted, his first tweet in years, which is the Spider-Man meme, right, where Spider-Man is pointing at Spider-Man. It's a reference to episode 19B of the 1967 series of Spider-Man called Double Vision, or Double Identity, where, there it is. And this sums it up so well, because to all intents and purposes, the experience of being on Threads is just as the meme on Twitter indicates. They are the same platform. It's just that Threads is so much more streamlined. There's no advertising on it currently, and it has much more limited functionality. Have you guys had a chance to play on it?
Not yet. These things take time with me, Ed.
Ask
a little
like
while.
2027. You might have a better shot.
Yeah, precisely. Yeah, it'll happen. We're just not sure exactly when yet.
When?
Ed, so how does it evolve? There's no desktop, which is a problem.
Yeah, and you have to have an Instagram account to start with. And what's so interesting, if you look at if you look at those that have developed a following really quickly, I just hit 300 followers. I did not have a big pre-existing Instagram following. Which may be one reason why I've been slow to build followers on Threads. Oh, look, there you go. You can follow me at Ed Ludlow TV. Thank you for that, team. The biggest piece of news to me was Mark Zuckerberg's comment on Threads that what we need is a platform with 1 billion people on it. And shout out to Dan Curtis on the charts and terminal team, but he made the point that all that Meta has to do is convert only 1 out of every 10 of its users across Facebook, Instagram, and WhatsApp to eclipse what Twitter was ever able to achieve. Think about the billions of monthly active and daily active users that Facebook has on its platform. They just need to convert a small percentage to get more than the 250 million or so that Twitter has.
Sure, but they also have to monetize it, and therein lies the problem.
Yes,
so
exactly.
What's the monetization plan so it doesn't wind up looking like Instagram?
So 2 analyst notes out this morning. Bernstein is out with a note saying it's hard to see how Threads achieves critical mass to kind of take on Twitter at that scale. And then KeyBank has a note out saying, and it raised its price target on the stock, but saying, in the near term, it's hard to see how this materially impacts financials. Longer term, advertising. And that goes back to what we started this conversation on, that it's a very clean feed. There is no ad on it currently. Contrast that with Twitter, where there are increasingly different kinds of ads and content in the timeline.
Ed, this is all nice and this is great, but as you say, it may not move the financial dial. AI is going to move the dial, particularly for Microsoft. It's increasingly clear which one of these big tech companies is becoming the kind of the AI monster, and it looks like it could be Microsoft, and I'm seeing note after note talking about that now.
Yeah, the latest being from Morgan Stanley, right, saying that the work that Microsoft is doing in AI and the commercialization they've done will push them to a $3 trillion market cap. Their new bull case price target, 415, reflects the assumption of a 3.01 trillion market cap. One very quick comment, Microsoft's very good at getting you to buy software that you could find for free elsewhere, and AI has really played into that story.
Fascinating stuff. Ed, great stuff. Thank you very much indeed. Ed and Caroline on Bloomberg Technology up in around 90 minutes time. Coming up on this show, investors await new jobs data out tomorrow. We're going to get more insight into our question of the day, Fed 6, BOE 7. This is Bloomberg.
great questions.
We're about an hour into a trading session. Good data, hot data, too good data, and you're looking at the Nasdaq 100 up by 1.3% off the lows, though, but nonetheless, an underperformance in the bond market. Abigail's tracking the moves. Abby?
Yeah, good news is bad news, clearly, at least for stocks, Alex. Take a look at the S&P 500 down 1.2%. The same thing for the Nasdaq 100. The Russell 2000 down more than 2%, and the stocks, that chip index, also down about 2% over the last 2 days. We have these indexes down. The S&P 500, I believe, the worst stretch in about 5 to 6 weeks. The stocks, the worst stretch going back to April. So we're seeing a little bit of bearish action emerging. It, of course, has to do with today, at least, that good news, that super hot news that Alex was talking about in terms of that blowout ADP report. That has sent yields soaring higher. If we take a look at the 2-year yield and the 10-year yield, take a look at this. The 2-year yield now comfortably back above 5%. Now, we saw it at this level in March briefly, right around the time Fed Chair Jay Powell testified before Congress, but then we had the regional bank issue and we had yields plummet. Well, now back above, and it seems as though it may just stay there, that 10-year yield back above 4%. And this, of course, is a piece of why we have stocks selling off, in particular, big tech. We've been watching Apple over the last couple of days. We now have Apple back below that $3 trillion mark, down 3 days in a row over that time period. Not a huge decline, down about 2%, but technically interesting things are happening for Apple, and it appears as though we could see this stock continue to come in. ExxonMobil, of course, this morning basically pre-announcing. General Mills a couple of weeks ago also having issues with the outlook. It feels like this earnings season could be a little bit choppy. When we put this together and take a look at the S&P 500, this is an easier way of taking a look at what we've been talking about with Apple. Here is the range. It's a little bit different, but you can see that this range has been fairly reliable. Now coming right off the top of the range, resistance, RSI coming out of the overbought territory. It seems very likely, Guy, that we could see the S&P 500 drop back closer to 4,000, maybe below, and so many different reasons why that could happen, potentially hot macro data, and then on the other hand, corporations having to change outlooks a little bit. It creates an interesting divergence that stock investors may not like.
They may not like it. Below 4,000, they're definitely not going to like it. Abigail, thank you very much indeed. Of course, they may be short. You never know. The U.S. labour market continues to show fresh signs of resilience. The data this morning has confirmed that. Companies adding almost 500,000 jobs last month, according to the data we've seen today. Remember, we get the payrolls tomorrow. Meanwhile, Federal Reserve Bank of Dallas President Lori Logan saying earlier today, more interest rate increases will likely be needed to battle inflation.
I remain concerned about whether inflation will return to target in a sustainable and timely way. And I think more restrictive monetary policy will be needed to achieve the FOMC's goals of stable prices and maximum employment.
Lori Logan speaking a few hours ago. Tomorrow, of course, we get another read on the jobs market. That brings us back to our question of the day. Is the Fed going to 6%? Is that the next logical target? Is the Bank of England going to 7%? Take a look at the Taylor rule on the Bank of England. I think it's somewhere near 14, so 7 doesn't sound so bad. Catherine Ann Edwards, Rand Corporation adjunct economist and Bloomberg opinion writer, joining us now to discuss the labour market. This is your bailiwick. Let's talk about the data we've seen today and what is happening here. Why is the labour market, Catherine, so resilient to the rate hikes that have been delivered thus far by the Fed and other central banks around the world?
I mean, you're basically asking why was the pandemic so special to our labor market? Why was this recession unlike any other we had ever seen? I think it's important to keep in mind we've never seen such a quick rebound in jobs, which is something we should ultimately be grateful for. But we've also never had such kind of coordinated start and stop of immigration, as well as a labor market to draw in workers so quickly. We're in a really special period that labor economists think of as the upside down, which is, whenever news is good for us, it's bad for the economy overall, and that's not something that we're necessarily accustomed to.
So to that point then, Catherine, hey, it's Alex in New York. Does that mean that a 6% Fed gets us there? Overdo it to compensate for the effects of the pandemic?
I'm not sure. I don't think one can be perfectly sure if you think about the shifting reasons for inflation over this kind of 1.5-year time period of the effect of the increasing federal funds rate. I think that because so many expectations of an increase are built into market and employer predictions by this point, it would be closer to keeping on track as opposed to breaking it to increase rates further.
Catherine, is the shift of the labour market permanent? Has Labour now got significantly more power? And once it's gained that power, how easy will it be to actually, in reality, take it away?
I have been impressed with the labor market gains, but I don't see them as being permanent because they have not been accompanied by any type of policy to reinforce those gains. We have not increased the minimum wage since 2009. We have not increased enforcement of wage theft from the Fair Labor Standards Act. You know, what the market giveth, the market can take it away. As many of your viewers know, workers are resting on wage hikes right now in a strong labor market, but if we don't have policy to reinforce those gains, even something so simple as requiring paid sick days for American workers, you know, they can be eroded as soon as the market gets weak.
Okay, I hear you on that. I just wonder, when you take a look at the ADP number then, hospitality and leisure, that was a huge contributor. Is that not real? Like, is that not a sustainable kind of, like, do those people get, you know, fired in September? Like, what happens to that kind of number?
Well, I mean, yeah, that's the industry that has the highest turnover in general. But I mean, I'll remind you that 45% of leisure and hospitality jobs were erased in a month at the start of the pandemic. This is a workforce that, if anything, the market has said is perfectly expendable. And that's not past, you know, distant past experience. That's recent for many of the workers because it was just, you know, a few years ago. Things that workforce doesn't have that a lot of us would probably take for granted is they don't have things like knowing when their shift is going to occur even a week in advance. Something around 1 in 5 leisure and hospitality workers don't know their shifts more than a week in advance. They often have to do things like clopening, where they close the store and open it the next morning, so there's less than 8 hours between their shifts occurring at nighttime. These are really basic labor protections that we've never enacted in the U.S., always for the sake of making sure that we have more jobs in this sector, even if their quality was steadily eroding over time. If we have a strong labor market with strong wage growth and high demand, this would be the time to encodify a lot of these gains because, you know, they can go away just like that.
Catherine, will demographics force things like this to happen?
The baby boomers have been getting older for some time now, and we've never really had a succinct policy to challenge that. You know, we tend to focus on the short-term external fixes. Should the baby boomers work longer? Should we have more immigration? The U.S. has long neglected to focus on labor supply of prime age workers that are already here. We could probably have 3 million more women working if we had paid family leave and subsidized childcare. We could probably have many millions more men working if we had a kinder way of dealing with formerly incarcerated persons and their resumes. There are lots of ways to increase the employment of workers with a disability if, again, we codified some of the flexible work arrangements of the pandemic into law. We often neglect our kind of existing 25 to 54-year-old population in terms of policy targets and focus instead on immigration and retirees, but that's not going to be a permanent solution to a disproportionately larger retired population.
Catherine, really interesting, making us think in a way that we hadn't before. Catherine Anna Edwards, thank you very much, of the Rand Corporation adjunct economist and Bloomberg opinion writer. Thank you. All right, coming up, OPEC's 8th International Seminar wrapping up. We're going to take you to Vienna for the latest. This is Bloomberg.
It is day 2 of the OPEC International Seminar in Vienna. Bloomberg's Manus Cranney is on the ground. Earlier, he spoke to the UAE Minister of Energy and Industry. This is what he had to say moments ago.
China growth is healthy. We're monitoring the market and we will take whatever decision. I am cautiously optimistic about the second half of the year.
Manus joins us now. Manus, you've been speaking to the Emiratis, you've been speaking to the Nigerians. What are they telling you?
There seems to be a consensus building that Cushing, we have a problem, and the problem is supply. Demand is firm. Mele Kyari, who runs NNPC, this is one of the biggest national producers in Nigeria. I said, there's an armada of Russian oil, you know, Mele, on the way to China, and surely that's your biggest issue. He said, it is not. The issue is there's an armada of demand. Of course, we were sparring with language there. Then Sahil Al-Mazrou was with me, and twice, and he was very, very clear with me, which is, I am optimistic about the second half of the year. The draws will come. The deficits will come. China demand is healthy. Global demand for oil is rising at about 2% per annum. He's been coming here for 10 years. Okay, last year was a bit of a real spike, a COVID recovery spike. But if you even it out, he's saying there is healthy demand. He also was very clear, Guy, when I sort of pushed him, I said, if the hat goes round in September, Your Excellency, and you're asked to pitch in on these unilateral cuts, are you ready? And he said, there has been no request to do so. So it was a very long conversation. We talked about renewables in the UAE, and we talked about this gathering. But there is a message to the market. The demand side is grand. That would be my take after 2 days of being stood outside in beautiful Viennese weather.
Well, yesterday we were complaining. It was raining. You got to pick a side, Manus. So how delicate, though, is that outlook for the back half?
We are dancing on a minefield of macro. Not my words. I wish I was as eloquent. That's Bob McNally at Rapid Energy. And again, when I pushed Mazrui on this, rates at 6% maybe in the US, maybe even fly a kite 7%. I know it's not consensus in the UK. How big a risk is that? McNally was at pains to say, look, this is the macro risk, that you could have another unintended consequence of materially higher rates. Mazrui was concerned about the interest rate cycle that we are in, but he wasn't as pessimistic, and I was trying to push him on that point. Just look behind me. This is the Kapinski. This is where the Emiratis are, the Iraqis are, the Nigerians are, the Kuwaitis have just arrived. There are meetings after the meetings of the symposium, and this is where you're going to build consensus and belief that the Russians will deliver on the 500,000 barrels of export drop that they have committed to. Rapid Energy reckons they will do it, and do it with more. That'll take you above $80. A little bit less robust view from Amrita Sen this morning. She said, Manus, they'll probably do about 400,000 down in terms of the exports, but that will help firm the supply side of this equation. Guy, Alex.
Manus, thanks a lot. We truly appreciate it. Thanks for staying late for us. Bloomberg's Manus Cranney joining us there. We want to continue the energy conversation because all of this jockeying to level the price and volatility is in the backdrop of a green energy transition that's happening globally. So we want to get a view on sort of the policy front. Melanie Kenderdine is Vice President of the Energy Futures Initiative Foundation and former Director of the DOE Office of Energy Policy. She served in government positions for years during the shale revolution here in the U.S. and exporting shale to the world. So Melanie, you're a wonderful person to talk to as we make yet another transition in the energy world. From where you sit, how long are we going to have oil and natural gas for? How important is this going to be to 2030, to 2050 climate goals?
Well, thank you so much, Alex. And let me say on how long we're going to need oil and gas. Energy transitions take many, many decades, quite frankly, but they're very different profiles for oil and gas use. Oil is used primarily for transportation, and I know everyone's excited about electric vehicles. We have about 250 million passenger vehicles on the road in the United States. In 2021, less than 1% of those 250 million vehicles were electric vehicles. So we expect that number to go up by to about 13% by 2035. So the transition from oil for passenger vehicles, light-duty vehicles, is a long-term transition.
Yeah.
The lifespan of a car is 12 years, and so just stock turnover is going to take a long time.
So then to that point,
heavy-duty vehicles, yeah.
Melanie, to that point, you got to plug all them in. So even if we do go to 13%, you still have to plug all these cars in, etc. You have talked to me at length about a really interesting calculation that you've done that says, look, if we get to climate goals by 2030, this is how many transmission lines that we're going to need. And that's like shovel-ready projects that we need to do. That's stuff we need to actually build. That's copper and nickel and carbon fiber that we need to make. Can you walk me through some of the calculations here?
I looked at, it's a reference frame, it's not reality, but it's based on reality, and looked at the number of transmission towers that you need for high voltage transmission lines to meet net zero targets based on Princeton's net zero analysis. And all the calculations I did said that by 2030, we need 360,000 transmission towers. Those towers are made from steel, aluminum, and copper. Okay, that's just the towers. The wires on transmission lines are also made steel, aluminum, copper. Wind turbines need steel, aluminum, and copper. Wind is the most copper intensive of any of the generation technologies. So cell towers are made of steel, aluminum, and copper. So the competition for those supplies just by 2030, the steel mills that we need, the copper mining that we need, very, very significant in a very short time frame. That's why things like the Inflation Reduction Act and the investments in there are very, very important. They can help accelerate the transition, but it is not an easy process, and we've got to be very, very thoughtful, sequenced, purposeful about that transition. I didn't address natural gas. Yeah, natural gas.
Okay, well let's
yeah. Okay.
Melanie, just what you just laid out to me sounds incredibly inflationary. How inflationary is the energy transition going to be, even if we do it at a relatively slow pace? Structurally, what's the inflation picture going to look like around all of this?
Well, what I can say is that the demand for copper has grown dramatically, and the price of copper in 5-6 years has doubled. Okay, so when you create huge demand for products, the prices go up, but I would also say to that the Inflation Reduction Act provides subsidies, funding, loan guarantees that will help with the inflation issues that you just asked about.
Melanie, do you think we have the right policies in place? And I realize that that's a huge question, but you have President Biden traveling today to commemorate an opening of a solar plant. There's going to be subsidies there. You were part of the Obama administration when the shale revolution happened. Do we have the right policies to make all of this happen?
I think that we've made major progress. The CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. We're going to need huge changes and additions to infrastructure. And so there are policies and programs in place that have been put in place very recently that will aid in that transition and helping to address the inflation and et cetera, et cetera. And so I think that we are in relatively good shape for the transition, but we need to pay a lot of attention. So,
Melanie, are the net zero targets realistic? Are we going to make them? And if we're not going to make them, how much are we going to miss them by? 128
countries in the world have net zero targets. it is and the dates vary, 2050, 2060, 2070, and very, very difficult to reach those targets. But I think that climate change is an existential threat to the world, and that the motivation for meeting those targets is when you are facing an existential threat are very important. Yesterday and the day before were the two hottest days in the history of weather record keeping, temperature keeping records in the history of the world. And so very, very serious issues that are becoming more and more obvious every day, providing motivation to meet those net zero targets. What we do have to do, however, is be very thoughtful and have sequenced policies on oil and gas demand. How do we reduce it? How do we get off it? Do we need CCS, which I strongly believe that we do? A whole range of policies that are needed to reach net zero targets. And we have to understand the goals and the technologies that we need to do it. We need to provide the incentives, and we need to not be ideological about it. We need to be thoughtful and technologically based in order to meet those targets.
Yeah, Melanie, CCUS, carbon capture and storage, so key if you're going to keep producing oil and gas also. Melanie, we appreciate it. It's really good to see you. Thank you so much, Melanie Kenderdine of the EFI Foundation. Thank you. This is Bloomberg.
Yields are up sharply, stocks are down sharply. That's the story after all of the data that we've seen today, particularly out of the United States, which paints a picture of a very strong U.S. economy, a very strong U.S. service sector. The employment report tomorrow could be the icing on the cake. Stock 600 down by 2.4% today, getting hammered. Every single sector's in negative territory. The legacy out of Asia wasn't good this morning. The story has continued. Stocks have suffered and accelerated to the downside. The move in the bond market has been extraordinary over the last few weeks, and it continues today. The UK 10-year yield now at 4.66, nearly 4.7. The market has now priced in 6